When you want to invest for this type of cash flow in the stock market, you are investing in a dividend. A dividend is a cash payment that a company gives you for doing nothing except owning the company. That means this company has so much extra cash, so much extra profit left over that they can just give it away to the shareholders. This means you get paid without having to sell your stocks. Now there's a couple ways that you can go about doing this. You can go out and invest in an individual company, or you can invest into a fund. And for the average person, I would say it's better for you to go out and invest in a fund as opposed to an individual company, because if you're investing in an individual company, you got to keep up with the company. You got to study the financial statements. You want to make sure that this company is not on the way to bankruptcy, because if you do that, well, you lose all the money that you invested, which is not a good thing. When you invest in a fund, now you're getting exposure to a broad basket of dividend paying companies. So if one company goes bankrupt, well, you're balanced out by the winners. I'll give you a few examples, but I gotta give you a disclaimer that I am just a random guy on YouTube. I am not a financial advisor. Make sure you do your own due diligence. Understand that investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. That being said, here are a few examples of dividend-paying funds that you can consider investing in. Number one is NOBL, Noble. Number two is SPYD. Number three is SCHD. And number four is VYMI. I am personally invested in these two funds, SCHD and VYMI here, which is why those asterisks are there. So let me break this down. NOBL, Noble, is a ETF that gives the exposure to dividend-paying companies in the S&P 500, but more specifically, dividend aristocrats in the S&P 500. What does that mean? If you take a look at the 500 largest companies in the stock market, that's the S&P 500. Out of those companies in the S&P 500, some of them pay a dividend. But then this goes a little bit more niche. What this says is we take a look at the dividend-paying companies in the S&P 500, but then we only invest in the companies that have increased and paid out a dividend every year for the last 25 years. That way, based off of historical data, these companies are more likely to continually increase their dividends in the future, or at least that's what they hope. At the time we're recording this video, it's paying out a dividend yield of around 2% a year. SPYD is a little bit broader. SPYD is an ETF that gives you exposure to dividend-paying companies in the S&P 500. So again, you take a look at the 500 largest companies in the stock market. This invests in the companies that are paying dividends in the S&P 500 and is paying, at the time we recorded this video, a 4% yield. SCHD is even more broad. This is investing in high dividend paying companies across the stock market. It doesn't have to be just in the S&P 500, but a broad basket of high dividend paying equity stocks in the stock market. At the time we recorded this video, is paying 3.3% a year. And then we have VYMI, which is a little bit more broad. This is investing in international dividend paying companies, high dividend yielding companies that are not inside the United States. Different levels of risk there, and at the time we're recording this video, it is paying out a yield of 4.3% a year. Now, the way that you succeed as a dividend investor is not to be a trader, is to be investing for the long term. That means you want to invest in a good asset and you want to hold on to it for many years, if not decades. If you want to see the best returns, it's not trying to hold on to it for 6 months, because that's not how you make money as an investor. I am not a trader. Trading is gambling. We're talking about investing for the long term, many years, because the reality is we're going to see market crashes. We're going to see recessions. They are a part of our system. You want to use those as an opportunity to buy even more. And the way that you win as a passive investor is you just keep buying every time you get paid. You buy a little bit every week, every 2 weeks, every month, and you just stick with that for years and decades. And that's how you build real wealth through the strategy, because history has showed us that that works. Now, if you want to stay up to date on what's happening in the markets, when it's happening, I have a free newsletter called Market Briefs, where every day my team is breaking down what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. It's completely free. It's read by more than 250,000 investors every morning. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.